Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. Look, if you've gotten serious about trading, you know it pretty quickly. Indicators, chart patterns, they aren't really the bottleneck anymore, are they? The real ceiling. It's almost always psychological. So our mission in this deep dive is to really get under the hood of uncertainty, how mastering that inherent market chaos transforms the emotional roller coaster into disciplined, sustainable execution. This isn't about finding a magic indicator. It's about managing yourself.
Exactly. And we have to start with something that, while it often feels disruptive, but it separates the pros from the churners. Here it is. Markets aren't uncertain because you lack skill. They just are uncertain. That's how they're designed. Prediction, impossible. Mastery is all about managing probability.
That distinction, skill versus just the fundamental design. Wow. That's tough for our brains, isn't it? We're wired to find causes to demand certainty. So when the market acts randomly, it feels like we failed.
It does. It feels personal.
You really have to change your whole perspective.
No.
Your job isn't predictor anymore. It's risk manager.
Precisely. And we need a really gut-level understanding of this. Think of it like this. Trading is like standing in a massive storm. You have zero control over the wind, the rain, the waves.
Right.
You can't just demand the storm stop because you want it to. It won't listen.
So what can you do?
You build a stronger boat. You learn to navigate using principles, chart a course, figure out how to ride out the waves. Clinging to the idea of certainty, that's like yelling at the hurricane.
It achieves nothing. Your focus has to shift to preparedness, not trying to prophesy.
Exactly. Preparedness, not prophecy.
Okay, let's dig into that clinical reality then. For traders aiming for, truly elite performance, why is certainty just fundamentally off the table? What makes the market inherently uncertain?
Well, the clinical insight, if you want to call it that, comes from understanding what a market is. It's a complex, adaptive system, meaning it's not like physics with neat, predictable laws. It's driven by literally billions of decisions. Countless people, all with different goals, beliefs, time frames, emotional states, fear, greed, everything.
All interacting constantly.
Constantly. And that creates feedback loops. Things emerge you couldn't predict, and just fundamental unpredictability, especially short term. The noise is just immense.
The one big player changes their mind or some news hits.
And boom! All the patterns you thought you saw can just vanish instantly.
Okay, so the inputs are human, messy, always changing. The output has to be probabilistic, not set in stone. Got it. But if it's also complex and noisy, how do we possibly build a strategy? How do we impose any structure?
And that brings us to maybe the most crucial distinction in professional trading. Life-changing, really. Uncertainty is not the same as risk.
Okay, unpack that.
Uncertainty is, well, it's infinite, it's unavoidable, it's just the weather, the nature of the market. Risk is different.
How so?
Risk can be measured. It can be managed. You can contain it, put boundaries around it. Amateurs try the impossible. They try to eliminate uncertainty.
What you just said is impossible.
Right. Professionals accept the uncertainty, they embrace it almost, and they focus on converting it into measurable, finite risk.
How? How do they do that conversion?
Through a disciplined process, through understanding their mathematical expectancy, using statistics, essentially, to navigate the chaos.
I see. So uncertainty is the background radiation, the constant storm. Risk is the part you define and control within that storm using your rules, your system.
You got it.
Okay, now let's pivot. This is where I think most traders really struggle. What happens psychologically, emotionally, when someone fails to truly internalize this unavoidable uncertainty?
Yeah, this is where the wheels come off for so many. What happens is the core psychological failure. Intolerance of uncertainty.
Intolerance, meaning they just can't stand it.
They can't stand it. And it usually comes from the ego, right? This hidden belief that the market should respect their analysis, their hard work, their intelligence.
I figured it out, so it should do what I expect.
Exactly. And when the market inevitably throws up a random loss or just chops around unpredictably, they don't see it as a statistical event. They see it as a personal insult, an affront.
And then the mistakes start piling up.
Oh, absolutely. We see the consequences constantly. Take a trader. Let's call him Alex. He's got a system. It's tested. It has an edge.
Okay.
But because he fears the possibility of a loss, that inherent uncertainty, he hesitates. He waits for extra confirmation, misses the entry. The trade takes off without him.
Classic hesitation.
Or maybe worse. He takes the trade, gets stopped out, takes another, stopped out again. Third time, stopped out. Now his ego, fueled by that intolerance of being wronged by the market, just screams, "This next one has to work. I know I'm right."
Oh, boy.
So what does he do? doubles the position size,
Yeah.
removes the stop loss entirely,
Disaster incoming.
and turns 3 small, statistically normal losses into one absolutely catastrophic emotional blowup. Wipes out weeks of gains, maybe more.
That's textbook loss chasing, isn't it?
Right.
Driven purely by wanting this one trade to prove him right, instead of thinking about the next 100 trades.
Precisely. Most trading mistakes really, they aren't about misreading a chart pattern or an indicator. They stem from this emotional attachment. Being attached to winning makes you euphoric, reckless. Being attached to being right turns normal losses into despair, triggering impulsive, irrational actions.
So acceptance of uncertainty isn't just nice to have, it's like psychological armor.
It is the armor, and it means you absolutely have to ditch the get-rich-quick dream where every single trade needs to be a winner. That's just not how probability works.
Okay, but let's be real. If someone's already deep in that emotional attachment, just telling them, hey, accept randomness, probably doesn't cut it. How do you actually internalize that, emotionally absorb the math? How do we build that stronger boat you mentioned? We need something concrete, actionable, a framework.
Absolutely. It needs to be a practical framework, and there is one. It's essentially a 5-step process designed to systematically shift you from emotional reactions to statistical execution.
Okay, let's hear it. Step 1.
Step 1, quantify your edge. This is non-negotiable, foundational. You must translate the uncertainty into a probabilistic framework using actual math, hard numbers.
Meaning back testing, tracking trades.
Yes, over a statistically significant sample size, 50 trades, not nearly enough. You probably need minimum 100, maybe 200 completed trades to start getting a reliable picture. And you must calculate your expectancy.
Expectancy. Give us a quick practical example of how a pro defines and uses that.
Sure, expectancy is basically what you expect to make, on average, per dollar you risk. The formula is straightforward. You take 1 plus your average reward to risk ratio times your win rate percentage, then subtract 1 times your loss rate percentage.
Okay.
So let's say you risk $100 per trade on average. Your average winner is $200, so your RR is 2 to 1. And let's say you win 45% of the time, meaning you lose 55%.
Right.
Your formula is 1 plus 2 times 0.45 minus 1 times 0.55. That's 3 times 0.45, which is 1.35 minus 0.55. That equals 0.80.
Meaning over the long haul, for every single dollar you risk, your system is expected to return 80 cents in profit. If that number is positive, you have a statistical edge. If it's 0 or negative, you're essentially gambling. You need this number.
That quantification really strips away the emotion from any single win or loss, doesn't it? The number is the only thing that matters long term.
Exactly. Which leads directly into step 2. Focus on process. Once you know you have a statistical edge, your only job during market hours is quality execution. Judge yourself on your inputs, not the outcomes, because you don't control the outcome.
What does that look like practically?
Did you follow your entry rules precisely? Did you use the correct position size? Did you place your stop where the plan dictated? Did you manage the trade according to the rules? We often advise traders track something like a process adherence score.
Like grading yourself on following the plan. Yes. Out of 10 trades, how many did you execute flawlessly according to your plan? If that score dips below, say, 95%, your entire focus needs to snap back to consistency. Forget the P&L for a bit. Fix the execution.
Because the market deals the cards, but you control how consistently you play the hand you're dealt.
That's a great way to put it. Now, even with a quantified edge and perfect execution, you will have losses. Strings of them. So, step 3, define and accept drawdown.
Drawdown being the peak to trough decline in your equity curve.
Correct. You must treat losses and losing streaks not as personal failures, but as completely normal, unavoidable operating expenses, like rent for a business.
So it's the cost of doing business in a probabilistic environment.
Exactly. And you must predefine mathematically what level of drawdown is acceptable for your system and your psychology. What's the maximum percentage of capital you're willing to see evaporate before you pause or reevaluate? Internalizing that this will happen and having a limit set in advance takes away so much fear and stress when that inevitable losing streak hits.
How does someone define acceptable? Is it purely a math thing based on the system's volatility, or is it more psychological?
It's really a mix of both. Mathematically, yes, it relates to your system's historical worst drawdown in testing, but psychologically, the real key is your personal pain threshold.
What you can stomach emotionally.
Right. If a 10% drawdown makes you lose sleep or triggers panic-driven mistakes, then your risk is too high for you, even if the system could theoretically handle 20%. A common guideline is risking no more than, say, 1% of your capital on any single trade. That way, even 10 losses in a row is only a 10% drawdown, usually survivable. The goal is staying in the game long enough for your edge to play out. Survival first.
Makes sense. What's next?
Step 4. Think in probabilities. This builds on everything else. Elite traders truly understand, deep down, that the outcome of the trade they're in right now, it's basically irrelevant in the grand scheme.
Irrelevant. That sounds harsh.
Well, irrelevant to judging their skill or the system's validity based on that one trade. It's just one single data point in a massive statistical series. It's not a test of how smart you are.
Yeah.
Get 7 winners in a row. Great. The system's playing out nicely. Enjoy the positive variance. Hit 5 losers. Okay, that's variance too. Doesn't mean the system's broken.
So detach from the immediate result.
Completely. Shift your focus from, will this trade work, to, how is my system performing over the last 100 or the next 100 trades? See the forest, not the individual tree.
That reframing definitely helps fight that very human bias for immediate gratification or despair, always thinking long-term probability.
Exactly. And finally, supporting all of this, the internal work. Step 5, build emotional resilience. This is where the rubber truly meets the road. This underpins your ability to actually execute steps 1 through 4 when the pressure is on.
Okay, this is the mind game part. We hear terms like mindfulness thrown around a lot. But for a trader, maybe leverage watching significant P&L swings. What specific habits actually help manage that intense stress, beyond just vaguely saying meditate more?
Right, it needs to be actionable. Resilience is built by actively managing the gap between feeling an emotion, fear, greed, frustration, and acting on it impulsively. Mindfulness, practiced correctly, helps create that space. It's about paying purposeful, non-judgmental attention to what's happening right now, including your physical sensations. When fear hits, your amygdala fires up. That's the fight or flight response. Physical tension, racing heart.
Yeah, we all know the feeling.
Mindfulness practices like focus breathing or body scans have been shown to actually dampen that amygdala activity. They calm the physiological storm.
So concrete practices.
A critical habit is regular meditation. And I mean regular. Ideally, 20 to 30 minutes daily, maybe before the market opens. This isn't about reaching enlightenment. It's about training your mind to maintain equanimity, calmness, balance, even when the market is going haywire.
Training the mental muscle.
Exactly. And structured journaling is huge, but don't just journal your P&L. Journal your emotional responses. After a trade, win or lose, immediately ask yourself, 1, what specific emotion did I feel right before I clicked the mouse? 2, did that emotion influence my adherence to step 2, my process? 3, what hard evidence do I have that this emotion was based on statistical reality versus just my psychological hopes or fears?
Wow, that's specific. It forces you to dissect the internal narrative, not just look at the result.
It weaponizes self-awareness. And of course, underpinning all mental techniques is position sizing.
Back to risk management.
Always. It's probably the most critical tool for managing emotional stress. If the amount of money you have on the line genuinely terrifies you, no amount of meditation is going to stop you from making impulsive mistakes eventually. You need to trade at a size where a loss stings, yes, so you respect the risk, but it doesn't paralyze you or trigger that panic response. That's the sweet spot for learning and maintaining composure.
This whole journey, then, it's really about moving from fighting uncertainty, demanding control you don't have, to genuinely embracing probability. That feels like the core psychological shift, moving from amateur speculation to professional execution.
That's it, exactly. We've covered that vital difference between uncertainty and risk, pinpointed the psychological killer intolerance of uncertainty, and laid out that 5-step framework for building both statistical rigor and emotional control. The real transformation in trading, it isn't finding some magic bullet indicator. It's fundamentally changing the person running the system, anchoring yourself in probabilities, not hopes and fears. So the question we leave you at, the provocation, is this. Are you still out there fighting the storm, demanding the market bend to your will? Or are you focused on building a vessel, your disciplined process, your statistical edge, your resilience that can actually weather that storm? Because traders who truly master uncertainty, they don't need control over the market. They need discipline, resilience, and a quantified edge. That's it.
Trading an edge where psychology meets profitability.